Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
We are talking here on October the 28th as the Q3 2019 earnings season kicks into high gear. And already we have seen some strong earnings reports and some not so strong. Kind of a mixed picture. We're going to get into that with our research director, Shiraz Mian, who is here with me right now. And I know you don't like me to talk about the mixed picture, but you got to talk about both sides.
Sure.
So while many companies have beat estimates, average earnings growth is still down. And there have been some high-profile earnings misses since you and I spoke here last. You think these high-profile misses are going to become a problem for the market?
The market has been able to just look past them. In many cases, these are company-specific issues. And I don't see it really as a problem for the market. The overall tone and substance of the releases is favorable, and that's what's driving the market.
Well, like I said, we're here on October the 28th. If last week's market performance is any indication, market approached new highs by the end of last week. Looks like investors, at least investors, not letting these earnings misses dampen their enthusiasm. But the more important question in my mind is, do these high-profile misses signal the dreaded earnings recession that everybody fears is getting closer?
No, I don't think so. And the reason for that is, Terry, that as we have discussed in the past, and I've written in the earnings commentary too, in addition to estimates for the period that companies are reporting, there was this fear in the market about companies coming out and guiding lower overwhelmingly about Q4 and about 2020, and driving that fear was this slew of negative economic data about China, about Europe, about even the factory sector here, and this synchronized economic slowdown, as the IMF called it in its recent report, was expected or feared to cause a major downturn in estimates, particularly for next year when the hope is for a rebound. That has not happened. So technically speaking, we may get 2 quarters of barely negative numbers, which the naysayers will call, hey, we told you guys there's going to be an earnings recession, and here we got it. But earnings recession really means a deterioration in corporate profitability. That is not what we are seeing. There's no growth, that's true, but that is because the comparisons to last year are so tough, when we had a 23% growth in earnings because of the very generous corporate tax cut that drove margins and earnings.
All right. Recap all the numbers for us.
Okay.
What do we have up to now?
Sure. So as you could see on the slide, 205 S&P 500 companies have reported through this morning. By the way, these 205 account for almost half of the index's total market capitalization. So we have a pretty good sample of results. Total earnings, as you rightly mentioned earlier, Terry, are down 0.2%. This is aggregate net income for these 205, not average EPS or average earnings. Total revenues are up 4.1%, 78% are beating EPS estimates, 62% are beating revenue estimates. Margins are down 60 basis points. 7 of the 16 sectors have weaker margins relative to the same period last year. And then I have these results in a historical context. In this slide, the left-hand side is comparing earnings growth, so aggregate net income for these 205 compared to what we saw from that same sample of 205 in other periods. And as you could see, earnings are down. There's no question about that. The revenue picture is a little bit better. 4.1% revenue growth here. It's been in that ballpark over the last couple of quarters, though significantly below what we saw from this group last year. And here is a comparison of the proportion of these companies beating estimates. So 78% EPS beats. That compares to 77.1% for the same group last quarter, 80.5% in Q1. And the 12th quarter average is 76.5%, so about in the same ballpark. And we see the same on the revenue side too. So no outsized misses or beats in this big sample, meaning we're just moving along historical trends in how these results are coming out.
And the fact that the beats are coming off a low bar, we don't even want to talk about that, right?
Well, it's a low bar, yes, but a lot depends on the future, Terry. And the future is looking as reassuring today as it was before this earnings season got underway, and that's the positive part about this earnings season.
All right, so when the dust settles, bottom line for Q3 is going to be what?
So we got about a flat earnings growth in the first half. It's down currently about 3% for Q3.
Okay.
My sense is that as this other 300 or so companies report, we'll probably be close to the flat line.
Okay.
It's possible that it's modestly in the red, but close to the flat line is my expectation.
This is the busiest week of the Q3
That's correct.
earnings season, and tech is going to take the spotlight. So what do you see happening there?
That's correct. And tech has been one of the laggards in terms of growth drivers. Tech has this reputation of being the faster growing part of the economy, but that's not what is expected of the group in this quarter. And I have here is the expectation for Q3. That's the highlighted portion here. As you could see, 8.5% earnings decline on 1.2% revenue growth. You could see here that earnings for the sector were down 6.3% in the first half of the year as well. Growth is expected to be negative in the current period, meaning in Q4 as well. And then things look up, as they always do, in the first quarter of 2020. You mentioned that it's a tech-heavy reporting this week. Yeah, so Apple has tough comparisons. Google's parent Alphabet is reporting they have tough year-over-year comparisons. And then the big drag has been the semiconductor industry. And the last time you were here, I shared a slide about how semiconductor earnings in Q3 are expected to be about a third below what that group had reported. So all of those factors are keeping the growth rate for the tech sector down. But my sense is that the decline will be a lot smaller than what is expected here once we have all the numbers in by the end of this week.
All right, there is another positive development that I think is worth noting, and it could be a big positive here going forward. It seems the talk of economic recession for the U.S. is not being spoken of at all in company conference calls.
That's correct, yeah, and that is a positive. And I never really bought into those doomsday kind of narratives anyway. Granted, the more trade-exposed parts of the U.S. economy have weakened, and that's what we were talking about, the factory sector earlier. But the consumer end of the economy is very strong, and that's a function of household balance sheets being in good shape, the labor market pretty strong, and in average wages steadily going up. So yes, I think it's a realization of the ground reality that even though growth has decelerated a little bit, U.S. economic growth, it is definitely not going negative.
So based on that lack of talk in these company conference calls of an economic recession, we should see continued positive guidance going forward.
Well, Yes, so guidance will be mixed. There will be some companies that will guide lower, but the overall tone and substance of guidance should not change materially from what we have been seeing over the last many quarters, and that we should see in estimates. And I have a big picture view of where the earnings picture is, as you could see here, Terry.
Estimates are coming down.
That's right.
For future quarters,
That's right. They have come down. So the for Q4 we have here -1%, and then in the first quarter we are expected to have 5.7%. So 2019 we all along knew would be challenged on a growth perspective, as long as estimates for next year don't go down in a major way. I think the market will take reassurance from that.
What if these estimates, these negative revisions trends accelerate in the coming days?
That's the risk factor. That's the risk factor, and that will be a function of what you mentioned earlier, that management teams are not mentioning the R word in the context of the U.S. economy. If the outlook for the U.S. economy comes down in a major way, if the wage gains that we mentioned in a positive context, if they go out of hand, meaning we have very strong wage gains which impact corporate margins, if the outlook for the global economy turns negative in a major way relative to what is expected, that is the downside risk, and that will be a problem for earnings and as a result for the market.
For now, though, there is still a sunny picture on the horizon.
Absolutely. The outlook is that growth resumes in 2020. We have a mid-single-digit earnings growth in the first quarter, and then that accelerates into the second quarter and the second half. So about 8-9% growth as a whole in 2020. Yes.
All right. Well, thanks for that. Remember, you heard it here first on Zacks.com with our research director, Shiraz Mian. You can read his written commentaries on our website as well and access them right off the homepage. They change twice a week. Mondays, he gives you the earnings preview. Thursdays, then, gives you the earnings trends or earnings outlook based on how the reporting season has been going up to that point. Here's something else you may want to check out for a limited time. You're invited to follow market insights, buys, and sells from all of our recommendation portfolios here at Zacks. And you can do it in real time, and it's only going to cost you $1 is what I'm being told. And you can even look into services that are exclusive and that have been closed to new investors up to this point. All you need to do is visit Zacks.com/promo for more details. With Shiraz, I'm Terry Ruffalo.